Risk on. That is how many would describe the investment mood in October. Well, take a look at this. It's a widely used high-yield ETF. And well, after taking a beating for most of the year, it was down more than 8% through the end of September. Well, you can see in October it was up more than 10%. Well, the question is, does the risk-on sentiment actually apply to the world of muni bonds? Well, joining us now with that answer is Pioneer Portfolio Manager Timothy Pynchon. He manages almost $900 million in the Pioneer High Income Municipal Fund. And Timothy, I never necessarily think of the sort of municipal bond world as being linked to the corporate bond world. But in your case, the way you really look at these individual issues is very much with a sort of credit perspective or credit hat on. So we haven't really seen that same thing happening, though, in high-yield munis, at least for October.
Well, that's right, Lisa. And, you know, we always start with credit. That's the beginning and that's the end for what we do in our fund. And to the degree that we're choosing our credits well, we should see performance in the fund. We're not exactly linked to what we're seeing in the marketplace today with regard to corporates and equities and how closely they're tied to the European happenings now, but we are tied to the Treasury market to a certain degree, not totally, more so on the investment grade side than on the high yield side. And so what we've been able to enjoy this year is basically delinking from a lot of the volatility that we've seen in the marketplace. And as we sit here today, the markets are up about 7.5%, 7.75%. So we've had very good absolute returns and on a relative basis, very strong relative returns.
Let's talk a little bit. This is a widely used indication of cheapness or richness in the market. It's the ratio of the yield on municipal bonds versus their sort of taxable equivalent, which would be treasuries in this case. And right now that ratio is a little higher, I suppose, than the average would be. But I was hoping you could give us a little Muni Bond 101 and explain why this is significant and what we should take away from it.
Sure. Well, what you're really referring to is what we refer to as the Muni Treasury ratio. And if we look on a historic basis dating back 15 years or so, what we find is that that ratio is typically about 85%, which in layman's terms would make sense because you're being paid for having taxable bonds. You'd expect having to pay tax on those that you would receive a higher yield, and thus a lower yield on the tax-exempt bonds. But what's happened this year and has happened over the last couple years following 2008 is that we've seen periods of time where that Muni to Treasury ratio has soared well above the norm. We're currently at about 110%, and of course with Treasuries fluctuating so rapidly on a day-to-day basis, that's been as high as 120% recently, and it's been as low as 105%. But the fact is that we're well above the norm, and that's a good indicator of cheapness within our marketplace. And said another way, that represents very good value in the municipal world. All
right, great. You answered my next question already. Now the question is, where do you actually find that value? We took a look at the breakdown in the portfolio that you have, and it's very much the way a credit sort of portfolio might look like. You have a makeup of sectors. Now, 30 or 40% roughly is in what you would call health. What is that from a muni bond perspective?
Well, certainly the healthcare sector is a very broad sector that would encompass hospitals and nursing homes and senior care facilities. For my purposes, I've had a concentration for some time now in the continuing care retirement community sector. And for me, that's a very significant deviation from the traditional hospital portfolio. And the reason for that is pretty clear from my perspective, which is that we remove ourselves from the Medicaid, Medicare reimbursement formula, which I personally am worried about as we move forward trying to close our gap both on the state level and on the national level. And so by virtue of being in the CCRC space, that's a private pay sector. And so we find very, very good value. We find very few investors who understand that subsector of the healthcare sector. And so as a significant part of our portfolio, we're realizing both tremendous yield and price potential as we place those very selective credits into our portfolio.
And Timothy, we don't have that much time here, but I do have to take a look at the credit quality of the portfolio. You have a very large percentage that's in not rated or what we would consider not rated bonds. not a typical Muni portfolio. How do you find value there, and how much more value is there than in sort of the AAA?
Well, again, I would submit to you that we have a very, very different composition than what you would normally find in an investment-grade portfolio. The non-rateds, for me, represent a very sweet spot in our marketplace, which is really exploiting the inefficiencies that we find throughout the non-rated, the below investment-grade portion of the Muni world. And so, by virtue of going to the non-rated market, all of a sudden you filter out most traditional municipal buyers, and you end up with a handful who, if they know what they're doing, and we think that we do know what we're doing, we find tremendous value for this portfolio. Those bonds can go in. The non-rated, the non-rating doesn't represent anything about the actual credit quality, but rather the fact that they simply have chosen not to get a rating for that issue. So we delve in, we peel back the layers, we find value, and if we like it, we add that to the portfolio, and that should sit there for years to come.
All right, Timothy, we have to leave it there. Appreciate your insight into a not so transparent part of the municipal bond market. Thanks for joining us on this Friday. That was Timothy Pynchon of Pioneer Investment Management. Okay, by the way, his fund year to date, or at least until the end of September, was up more than 8%.